£136,000. That's the inheritance tax bill HMRC will collect from a single pension pot of £340,000. A pension pot that, until April 6, 2027, would have passed to your children completely tax-free. Finance Act 2026, which received royal assent on March 18, 2026, rewrote Section 150A of the Inheritance Tax Act 1984 to bring unused pension funds into your taxable estate for the first time in British pension history. Your pension, the one asset you were told sits outside inheritance tax, the one asset every financial advisor for 30 years called the most tax-efficient way to pass wealth to the next generation, is no longer protected. From April 2027, it's treated identically to your house, your savings, and your investments. And HMRC estimates this single change will pull an additional 8% of all UK estates into inheritance tax liability that previously owed nothing. Richard Greaves, 72, from Cheltenham, spent 26 years contributing to his SIPP. He retired at 66, drew his 25% tax-free lump sum, and left the remaining £340,000 invested in Drawdown, specifically because his financial advisor told him in 2019, "Leave it untouched. When you die, it passes to your daughters outside your estate. No inheritance tax, no probate delays." That advice was correct in 2019. It becomes catastrophically wrong on April 6, 2027. Richard's daughters now face a potential £136,000 tax charge, 40% of £340,000 on money their father spent a lifetime accumulating. What Richard doesn't yet know, and what I'll explain in the next 90 seconds, is that there are 3 specific types of pension death benefit that this change affects differently. One remains completely exempt, one becomes partially taxable, and one triggers the full 40% charge with no relief available. The difference between them determines whether your family pays nothing, pays something, or pays everything. I'll identify all 3, and more critically, I'll show you exactly what to restructure before April 2027 to protect the maximum amount legally possible. But first, you need to understand why HMRC made this change now, after decades of pensions sitting outside the estate. Because the reason reveals their enforcement priority for the next 5 years. When George Osborne introduced pension freedoms in April 2015, he removed the requirement to buy an annuity at retirement. Suddenly, pensioners could leave their entire pot untouched in Drawdown, live off other income, and pass hundreds of thousands of pounds to their children, entirely free of inheritance tax. HMRC watched this happen for a decade. Treasury receipts show that inheritance tax revenue climbed to £7.5 billion in 2024 to 25, yet pension wealth, estimated at over £900 billion held by retirees in Drawdown A, contributed nothing to that figure. The government's own consultation document, published alongside the Autumn Budget 2024, stated bluntly, "Pension schemes are increasingly being used and marketed as a tax planning vehicle to transfer wealth rather than for funding retirement." That sentence is the thesis. HMRC decided that pensions had become inheritance tax shelters, and they closed the shelter, not partially, completely. From April 6, 2027, your personal representative, your executor, becomes responsible for reporting the value of your unused pension funds to HMRC as part of your estate. They must contact every pension scheme you hold, request a date of death valuation within 28 days, and include that value alongside your property, savings, and other assets in the inheritance tax account. If your combined estate, including pensions, exceeds the nil rate band of £325,000 plus the resident's nil rate band of £175,000, the excess is taxed at 40%. For a married couple, the combined threshold is £1 million, but only if the resident's nil rate band is available which requires you to leave your home to direct descendants and have a total estate below £2 million. Above £2 million, the residence nil rate band tapers by £1 for every £2 over the threshold. A couple with a £500,000 house, £300,000 in savings, and £400,000 in combined pension pots now has a gross estate of £1.2 million, meaning their residence nil rate band is already reduced by £100,000. Before the pension change, that estate was £800,000 for IHT purposes, comfortably within the £1 million threshold. No tax. After April 2027, the same family owes inheritance tax on the excess. And depending on how benefits are structured, that bill could reach 5 figures. I'd be genuinely curious. Has your financial advisor already contacted you about this change? Because from correspondence I've seen from multiple pension providers, most are only now beginning to send generic letters about April 2027, with fewer than 10 months remaining. If your advisor hasn't raised this with you yet, consider what that tells you about their attention to your estate planning. Now, the 3 categories of pension death benefit and how each is affected. Category 1. The dependent scheme pension. This is a pension paid to your surviving spouse or civil partner from your defined benefit scheme after your death. Under the new rules, this remains completely excluded from inheritance tax. Section 150A(6) of the amended IHTA 1984 defines it explicitly as an excluded benefit. If you have a final salary pension that pays a 50% spouse's pension on death, that pension is not included in your estate. Your spouse receives it tax-free for IHT purposes, exactly as before. Dorothy Ashford, 69, from York, has a teacher's pension that pays her husband a 50% dependent's pension when she dies. That pension, worth approximately £6,800 per year to her husband, is not affected by the April 2027 changes. No IHT. No reporting requirement for that specific benefit. Dorothy's pension scheme confirmed this in writing when she called in May 2026. The relief here is genuine. If your pension death benefits are structured as a dependent scheme pension, you're protected. Category 2. The lump sum death benefit from a defined contribution pension where you die before age 75. Before April 2027, this lump sum passed to your beneficiaries free of both income tax and inheritance tax, provided your pension provider paid it within 2 years of becoming aware of your death. After April 2027, the lump sum still avoids income tax if you die before 75, but it now counts toward your estate value for inheritance tax purposes. The income tax exemption remains. The inheritance tax exemption is gone. This is the category that catches most people off guard. Richard Greaves, the man from Cheltenham, holds a SIPP in Drawdown. If he dies tomorrow, age 72, his daughters receive £340,000 income tax-free and inheritance tax-free. If he dies after April 2027, they receive £340,000 income tax-free but inheritance tax liable. Same pension, same amount, same family. Different date of death, £136,000 difference. Category 3, lump sum or drawdown death benefits where the member dies after age 75. Before April 2027, these were subject to income tax at the beneficiary's marginal rate, typically 20% or 40%, but remained outside the estate for IHT. After April 2027, they face both income tax and potential inheritance tax. However, and some tax practitioners debate whether HMRC's guidance on this point is sufficiently clear, a credit mechanism exists to prevent genuine double taxation. The income tax paid by the beneficiary should reduce the IHT liability, but the administrative process for claiming this credit has not yet been fully detailed in published HMRC guidance as of August 2026. Margaret Thornton, 78, from Reading, has £180,000 remaining in her SIPP drawdown. She has 2 sons. If Margaret dies after April 2027, her sons receive that £180,000 as drawdown income, taxed at their marginal income tax rate. But the £180,000 also forms part of Margaret's estate for IHT. Without the credit mechanism working correctly, her sons could theoretically face both 40% income tax and 40% IHT on the same pot. HMRC's technical note states this won't happen, but the detailed guidance explaining exactly how the credit operates won't be published until spring 2027. That's after the legislation takes effect. Margaret's sons will need to trust that the system works correctly before they can see the manual explaining how it works. If any of what I've just explained has made you reconsider your pension structure, if you've realized that your pot sitting untouched in drawdown is no longer the estate planning asset you thought it was, pressing the like button takes 2 seconds and signals to the algorithm that this information matters before April 2027. Every pensioner with a SIPP, a drawdown arrangement, or a defined contribution pot needs to hear this. 2 seconds from you helps make that happen. Everything I've described so far is about understanding the problem. Here's the catch that changes all of it, and it's the part most people won't hear from their pension provider. The legislation includes a mechanism called the Pensions Direct Payment Scheme. Under new Section 226B of the IHTA 1984, your executor can issue a payment notice to your pension scheme administrator, instructing them to pay the inheritance tax directly to HMRC from the pension fund itself, before distributing the remaining balance to beneficiaries. The pension scheme must comply within 35 days. This means your children don't need to find £136,000 from their own pockets to pay the IHT before they can access the pension. The tax comes out of the pot first. That sounds helpful. It is helpful, administratively. But consider what it means in practice. If Richard Greaves dies with £340,000 in his SIPP after April 2027 and his estate exceeds the nil rate band, his executor issues a payment notice for £136,000. The pension scheme pays HMRC directly. His daughters receive £204,000 instead of £340,000 from a pot that, 12 months earlier, would have passed to them in full. There's also a withholding mechanism. Under new Section 226A, your executor can issue a withholding notice requiring the pension scheme to freeze up to 50% of each beneficiary's entitlement while the estate is being administered. The scheme cannot pay more than 50% of benefits to any beneficiary while this notice is active. The notice lasts up to 15 months after the month of death. During that 15 months, your family has access to only half of their inherited pension. The other half sits frozen while executors calculate, report, and pay the IHT. Graham Whitfield, 74, from Exeter, died in June 2024, before the April 2027 changes. His wife, Barbara, received his £220,000 SIPP within 6 weeks. No IHT, no withholding, no executor involvement with the pension at all. If Graham had died 3 years later, June 2027, Barbara would face a potential 15-month withholding period, executor involvement, information sharing between the pension scheme and HMRC, and a possible tax charge unless the spousal exemption was properly claimed. Same pension, same couple, same love and loss. Radically different financial outcome depending solely on the calendar. I understand this is a lot to process. The interaction between pension schemes, inheritance tax, withholding notices, direct payment mechanisms, income tax credits, and spousal exemptions. None of it was designed for clarity. It was designed for compliance. But what matters to you, practically, in the next 10 months is this. What can you actually do? If you've watched this far, you're not someone who leaves financial decisions to chance. Subscribing to this channel means you'll see the video I'm releasing next week on the 3 specific pension restructuring strategies that reduce your IHT exposure before April 2027, including one approach that some estate planners call aggressive, but HMRC has never successfully challenged at tribunal. That video connects directly to everything we've covered today. This next section, some viewers skip it because it sounds technical. Don't. This is where the £136,000 becomes something smaller, possibly much smaller. Strategy 1. Draw down your pension before April 2027 and move the funds into exempt or relieved assets. Every pound you withdraw from your pension before death is no longer unused pension funds. It's cash, ISA savings, or spent income. If you withdraw £50,000 and place it in a stocks and shares ISA, that £50,000 still forms part of your estate, but you've gained flexibility in how it's treated and who it's held by. Some couples are accelerating drawdown, paying the income tax now at 20% and gifting the after-tax amount to children under the 7-year potentially exempt transfer rules. The income tax cost is 20%. The IHT saving, if you survive 7 years, is 40% of the gifted amount. Some pension advisors consider this aggressive planning. Others point out that it's entirely lawful under current legislation, and HMRC's own guidance on pets has not changed. Sylvia Hammond, 68, from Bath, held £280,000 in her SIPP drawdown. In January 2026, after the autumn budget announcement, she began drawing £40,000 per year above her normal income needs. She pays income tax at her marginal rate on the excess. She then gifts £30,000 per year to her 2 adult children, using her £3,000 annual gift exemption plus additional amounts treated as potentially exempt transfers. If Sylvia lives 7 years from each gift, those amounts fall completely outside her estate. She's voluntarily paying 20% income tax now to avoid her children paying 40% inheritance tax later. Net saving per £30,000 gifted, approximately £6,000. Over 5 years of this strategy, £30,000 saved for her family. Strategy 2. Ensure your death benefit nomination forms direct pension benefits to your spouse or civil partner. Under Section 18 of the IHTA 1984, transfers between spouses are exempt from inheritance tax. This hasn't changed. If your pension death benefits pass to your spouse, they remain IHT-free, even after April 2027. The risk is if your nomination form names your children directly, or if your form is outdated and names a former spouse, or if you have no nomination at all and the scheme trustees exercise discretion. In the last scenario, trustees might pay benefits to your adult children, triggering the full IHT charge, when directing them to your surviving spouse would have been completely exempt. Check your nomination form this week. If it names anyone other than your spouse as primary beneficiary, and your estate is likely to exceed the nil rate band, you may be creating an unnecessary tax charge. Some pension holders deliberately name children because they want the money to skip a generation. After April 2027, that choice costs 40% in a way it never did before. Strategy 3. Consider whether a joint life annuity, purchased before April 2027, provides better protection than remaining in drawdown. Under the excluded benefit rules in Section 150A(6), a dependent's annuity purchased together with a lifetime annuity is exempt from IHT. If you convert part or all of your drawdown pot into a joint life annuity before April 2027, the continuing payments to your spouse after death are treated as an excluded benefit. The pot no longer exists as unused funds. It's been exchanged for a guaranteed income stream that falls outside the estate. This isn't right for everyone. You lose investment flexibility. You lose access to the remaining capital. Annuity rates, while higher than 5 years ago, still represent a permanent trade. But for pensioners whose primary concern is protecting their spouse from a tax bill on their death, and who don't need the drawdown flexibility, a joint life annuity purchased before April 2027 converts a taxable lump sum into an exempt income stream. The arithmetic is worth running with your advisor. Here's what nobody connects, and it's the piece that pulls this entire video together. The withholding notice mechanism, the direct payment scheme, and the information sharing regulations between pension schemes and executors create a completely new administrative burden on your family after your death. Before April 2027, a pension passed outside probate. Your trustees made a decision, paid the beneficiary, and HMRC never touched it. After April 2027, your executor must identify all your pension schemes, request valuations within 28 days, include those values in the IHTA account, potentially issue withholding notices, calculate tax across multiple pension schemes, issue payment notices, wait for 35-day payment windows, and manage the income tax credit mechanism on overlapping charges. That's not a tax change. That's a complete restructuring of how your family experiences your death, administratively, financially, and emotionally. Your Monday morning action plan. Monday, log into every pension scheme you hold and check your current fund value. Write down the total across all schemes. Tuesday, add that total to your property value, savings, and investments. If the combined figure exceeds £325,000, single, or £650,000, couple, you are potentially affected. Wednesday, check your death benefit nomination forms on every pension scheme. Confirm they name your spouse as primary beneficiary unless you have a specific reason to name someone else. Thursday, call your pension provider and ask one question. What changes are you making to your death benefit administration process for April 2027? Their answer tells you whether they're prepared. Friday, book a meeting with a STEP-qualified solicitor or chartered financial planner who specializes in estate planning, specifically to discuss your pension structure in light of Finance Act 2026. 5 days, 5 actions. That's how you convert a £136,000 future liability into a structured plan that protects as much as legally possible. Richard Greaves, the man from Cheltenham, hasn't yet made these changes. His daughters forwarded him an article from the Financial Times in June 2026 explaining the new rules. Richard called his advisor the following Monday. That advisor, the same one who told him in 2019 to leave his pension untouched, has now recommended Richard begin drawing an additional £25,000 per year from his SIPP, paying income tax at 20%, and placing the after-tax amount into a joint investment account with his wife. If Richard lives 4 more years, approximately £80,000 in post-tax funds will sit in an account that, if transferred carefully, his daughters may eventually receive with substantially reduced IHT exposure. Richard's advisor didn't get it wrong in 2019. The rules changed. But the advisor who doesn't update your strategy when the rules change, that advisor costs you money through inaction. And HMRC never sends refunds for advice you should have received but didn't. In the next video, I'm covering the 3 assets married couples must restructure before one spouse dies, specifically how property ownership, pension nominations, and investment accounts interact with the April 2027 changes to create a compounding inheritance tax exposure that most couples don't see until the first death triggers a bill they never expected. That video drops within the next 7 days. Your pension was built over decades of sacrifice, discipline, and deferred spending. For 30 years, the law protected it from inheritance tax. That protection ends on April 6, 2027. The question isn't whether the change is fair. The question is whether you'll restructure before it applies, or explain to your children afterward why you didn't.